Hi, good evening all. On behalf of FICCI, I would like to welcome you all for the FICCI-IAN Startup Investment Series. So, to give you a background, this series has been launched under the umbrella of FICCI for Startups initiative. Under the series, we are conducting 6 sessions covering different aspects of Indian investment ecosystem. That includes the type of funding available, mechanisms of startup to avail the opportunities, what investors seeks from the startups, how to make successful pitch, and so on. So out of 6, 3 are already being conducted, and this is the 4th session of FICCI-IAN Startup Investment Series, which is in the partnership with Bharat Innovation Fund. So today we have with us Mr. Ashwin Raghuram, who is a co-founder and partner at Bharat Innovation Fund, a venture capital fund investment in early stage innovation driven technology startups in India. The fund made 13 investments to date from 2 investments vehicles. Prior to this, he was the founder and chief operating officer at the India Innovation Fund, also an early stage venture capital fund, supporting IP driven startups in ICT and life science sectors. The fund was set up in 2009 and achieved a full exit from its portfolio in early 2017. Ashwin is also a mentor at the NASCOM Deep Tech Club and a member of investment committee of various BIRAC financing schemes for startups. So before I hand it over to Mr. Ashwin, I would just like to brief that we will be taking the questions post the presentation, and Ashwin would try to answer that. So over to you, Ashwin.
Thank you so much, Nitin, for that introduction and for hosting me. Good to be here. Good to be talking about what we are doing, and I think a little bit of a introduction into the topic at hand, which is really what is happening on the fundraising side. And fundraising, as you all know, anybody who's done any of it, it's more of an art than a science. There's no clear rules, and there are some things to be kept in mind, and I thought I'll share some of our learnings as we have interacted with startups, both who have tried to raise with funds from us, as well as our startups which have come into our portfolio. We've helped a lot of them go on to raise follow-on rounds of funding, and the intent is to be able to share whatever learnings we've got over the years. Is my presentation visible? Nitin, if you can help me.
Yes, sir, it is visible. Just make it a slideshow, sir.
Yeah, I will do that in a minute. Sorry, just having some trouble with that. Let me do that again. So let me just keep going like this, Nitin, if you don't mind.
Fine, sir. Fine.
Yeah,
Yeah.
because I think there's some trouble in getting to slideshow.
Okay.
So our topic at hand, the art of the fundraise. So how do you do it? What does it take to, get into a fundraise mode, and what are the challenges around that? I'll just try and give you a sense of how we as investors think when we are actually, evaluating companies which are looking to raise capital. That is, something that will help entrepreneurs understand who they are approaching better, and really figure out what it is that we look for and what are the challenges that we face when we look at entrepreneurs as well who are trying to raise capital. But before I go there, let me give you a little bit of an introduction to the Bharat Innovation Fund. So we're an early stage venture capital fund. We invest in deep tech startups, anything from a pre-series A to a series A round, and which means a ticket size of about 500K to 3 million US dollars as our first check. And then we participate in follow-on rounds. We've made 7 investments to date in the last 2.5 years that we've been up and around, of which 3 have already got follow-on funding. These are some of the companies that we have in our portfolio: Entropic, Detect, PlayShifu, VPhrase, Fire Compass, Zomator, and Credit Vidya. 3 or 4 of these are actually ML and AI companies in diverse sectors, whether it's media tech with Entropic, or if it is NLG with VPhrase. With Credit Vidya, it's more in the fintech space, digital lending, and then with Fire Compass, it's in the security space. But we have gone to other sectors such as Detect, which is in the oil and gas sector as well. Zomator in the biotech sector has a drug molecule, or it's a drug discovery play. And PlayShifu is an AR/VR play in the education space. So we are fairly diverse in what we look at with a common filter of deep tech. We invest early, we keep dry powder to participate well, and we are looking at startups that address global markets and have customers globally. So most of these 7, when we invested, would have either had a global customer or have the potential to get there very soon. And happy to say that most of them have a global flavor at this point in time. So that's not our only vehicle. We also invest out of another vehicle. It's called the Bharat Inclusion Seed Fund, which is a little bit more focused on impact investing towards India-focused startups. So anybody who's catering, or any startup which is helping using technology the lives of people at a lower socio-economic background or economic backgrounds, and through interventions in either financial support, banking, areas like insurance, education, and other gig aggregation, and so on and so forth. Here also we have 7 investments. The 7th one is a little bit blanked out because we are yet to announce it. It will probably be announced in a couple of weeks. But anything across financial products to education and pariksha, discoveries, and insurance company, and so on. Here also we have already got 3 follow-on rounds. We invest anything from 200,000 US dollars to about $1 million dollars out of this fund. And all of this is really the sister organization that has promoted both these funds is a very early stage incubator called FICCI-IAN.co, which is based out of a physical facility based out of the Indian Institute of Management in Ahmedabad and the campus over there. Been around for over a decade and has incubated several startups at a very, very pre-seed stage. Also runs several accelerator programs over the years, and you can see some of the statistics of number of startups that have been supported. So that's a little bit of who we are. I've been in the venture capital industry for now about 12 years or so. This is my 2nd fund, and I think Nitin was kind enough to talk about what I did earlier, so I won't repeat it and just jump straight into the topic for the day. And I think every time I speak to a set of entrepreneurs who ask me about raising capital from VC funds, I think there are some questions that you really need to ask yourself before you embark on it. And the first question is really, do you really need venture capital, right? And do you want to take it? And it's a very tough choice. It's a very, very important choice. There are times you may say, listen, I will continue to remain either a family-backed business or a promoter-driven business. I don't want to have venture capital, and choose not to take it. And we've had some large successes like that already that we have seen. But if you want to take venture capital, then you need to be clearly aware that you have to work closely with an investor who will also be looking to monitor you and to be able to contribute. And so you'll have to build a partnership with a fund. So clearly a very important question. The other important question to ask is, when do you need this venture capital? There are different stages that you may want to evolve to before you start raising capital. And based on the stage, there are also different types of financial instruments that you can use. For example, very early you may choose to get more of the grant funding, and then you will slowly evolve to angel type funding, friends and family type funding. Angel networks are there. There are significant number, VC funds eventually, and then which VC fund for which type of a stage. These are all questions that you need to figure out, ask yourself, when do you need it, and then who do you go to, right? How do you start raising capital? I think is a question I get asked very often. What is the first step? And perhaps at the end of today's conversation, some of what we talk about will already answer that question, albeit indirectly. And who do you raise from, right? So within the VC community, assume you've chosen how to raise, or who to raise, as in you wanted to raise from a venture capital fund. Within that VC fund ecosystem, which fund is right for you, which is the one that you should approach, is a very important question, I think, for two reasons. One, simply because you need to become a long-term partner, or think of a VC fund coming in as a long-term partner, and therefore very important to really figure it out as to who is going to be that match with you, who is going to really be able to help you in your growth journey. And I think the other important part is when a lot of entrepreneurs try to raise capital, they go to just far too many VC funds because they don't have a focused approach. It's very important to understand who are the guys who will really back you and who will be interested in your story. And it's very important to understand which VC fund is looking at a startup such as yours. Otherwise, you will end up touching too many VC funds. You'll get too many no's simply because there's no fit. And then there is always discouragement and disappointment as a result. And there is what we call, fundraise attrition that happens with the entrepreneur. They get disillusioned. So be strategic about it. Find out which VC funds will be relevant to you. Look at their portfolios closely. Look at what all of us put out a lot of articles. We put out write-ups on why we invested in certain startups. We do a lot of podcasts these days. We speak to on panels. So try and look that up. Do a little bit of background so that you understand who are the right guys for you when you go out and raise capital. Now, let's assume you've figured a little bit about what's happening in the venture capital funding ecosystem. I think understanding who you're going and approaching is extremely important. And the next half an hour or so, I intend to try and talk about a little bit about what is it that you need to know about us, our mindsets, broad thought processes, some of the things that we look at. Because once you know who you're approaching, I think your ability to approach that person better becomes just so much easier, and you can make it a lot more of a strategic, well-informed conversation rather than a shot in the dark. And I think the first question you have to ask yourself is, who is really a venture capital fund's customer? So do venture capital funds have customers? This is a question that was actually put to me by somebody who used to run perhaps Europe's largest, it was a fund, EIF, which is a fund that is the European Union's fund, almost like a sovereign fund, and invests across other VC funds. And he said, who do you think it is? Are they the startups? And obviously, after thinking it through, it's very clear that our customer is our investors, right? So we raise capital as well from a bunch of what we call LPs or limited partners. And we promise them certain, not just returns, but we also tell them that this is the strategy that we will deploy when we are investing. We are, this is the team that we are. This is how we will go about. This is our investment thesis. And then, for example, what I said earlier, that we will invest in deep tech startups, is a story that we would have taken to our investors and pitched to them for them to actually back us and say this strategy makes sense. And so we try to adhere as far as possible to what we promised our customers, and we also interact fairly regularly with them. So a lot of our decision making is also driven by those promises and those interactions and those engagements. And it's important to know that we have a certain life that we typically have. It can range anything between 8 to 12 years as a fund. And in that period of time, we have to invest in n number of startups, help the portfolio build, help these startups grow and scale, and then eventually get some exits and give returns back to these investors who have backed us. And at the same time, there are sometimes some strategic, sort of a relationship with these investors as well. They often become, if they're large corporates, they become customers in some cases to our startups. They also use us very often to understand what is happening in the startup ecosystem, to think about acquisitions, and so in a variety of ways we engage with our customers. But most importantly, it's important to realize that we need to demonstrate returns and return capital to them with what are, risk weighted type of returns. And so that's what we look to do with our startups, and we build portfolios to mitigate risk. And so don't concentrate with one or two startups, but a range of startups. Out of our two fund vehicles, we are likely to invest in anything between 22 to 25 startups. And that's what we think is a manageable portfolio. And some of them will fail, some of them will die, and our money will be eroded. So very important that the ones that succeed big for us. And every time we make a startup investment decision, we really look at the ones that are going to scale big and generate big sufficient returns for us. So that's a little bit about how we think about our customer, and then startups are perhaps our partners in our journey to be able to service our customers. So I think all of y'all, or many of y'all who are startups here, would have watched this show. And if you haven't, please do. Shark Tank is very popular, right? And so this is a snapshot of somebody pitching on Shark Tank. And if you really think about it, there are 5 or 6, sometimes there are some guest investors or guest sharks who appear on Shark Tank, right? And these 5 are possibly the most common, the ones that come most commonly, along with Damon John. And if you really observe it, the questions they have when a startup pitches to them is very indicative of what are the key things running through their mind. And very often you'll see a pattern that every investor has in some of the questions they ask. Many of them are sometimes common, in the sense some questions are common to all investors, but you would, over a period of time, as you watch more and more pitches, understand that different people focus on different things. And so if you look at the right, you have a Mark Cuban who's a very tech, he's knowledgeable about tech, he's knowledgeable about product. So he really wants to understand what is the driving tech, what is the driving product, and unit economics as well. What is the price at which you sell it? What does it cost you to make? Is a question that you hear most from him, even if you hear it from the others once in a while. Whereas if you look at a lot of deals, and this is self-confessed by Barbara Korkikin, who's another angel there sitting, right in the middle, she looks at the team very often and backs the founder, right? And tries to understand the background, the passion of the founder, and some gut feel about the founder in her investment decisions more than anything else. And she says so herself. Kevin O'Leary, the guy right in the middle, he talks about structures a lot, some innovative financing structures, so that he can make money. Thinks about the exits very early, even with some of the youngest startups already trying to figure out how he's going to make money, how is he going to exit it. Looks very closely at portfolio fit. So for example, he has a number of portfolio companies in the wedding space. So if there's a new one that comes and pitches, which has a, fits a gap in his portfolio on weddings and the market related to weddings, there's a great chance that he will bite and he will pick it up. There's Robert, who's sitting at the end, and he thinks about business models. A lot of his questions are what are the business models, more than just the product and service. And there's Laurie, who's the other lady in the middle between Kevin and Robert, who pitches a lot of these products through a television show that she's the host of, and therefore, has a lot of consumer focuses on very consumer aspects like packaging often, but very interestingly, also very keen on understanding what is patented, what is proprietary, and what is differentiated from a tech standpoint, right? So what is the moral of the story here? Everyone may have a distinct investing style. And when you think about funds in India, all these funds have got different investing styles. Every fund possibly has each of these components that are looked at that I mentioned. in some proportion or the other, or some percentage of the other. But the percentages vary, the proportions vary. So some funds such as ours, we look so much more at, let's say, patents, we look so much more at the tech, and there could be other things, for example, like exits that we don't think about so much at the stage we invest in. But there could be another fund investing at the same stage, which would still talk about or think about exits and have a bigger conversation with you on all of that. And so we are really a mix of all of these. We look at every single one of these as funds. And even within funds, if you speak to, so we are 5 partners in our fund. If you speak to one of my other partners in this fund, they may focus on some of the other aspects that I may focus less on, and they may be lower on some aspects that I am very keen on. For example, unit economics matters a real lot to me, and so a lot of my questions are there. And so we all look at many aspects, but some are more important than the others. And it's great to try and understand when you're approaching investors what matters to which one, because then you'll be well prepared for that investor conversation. So just to carry the thought further, right? I follow a philosophy which I love, which I got from something that was said by one of the world's greatest sportsmen ever, a guy called Wayne Gretzky, who's a Canadian ice hockey player, and he is perhaps the Michael Jordan. What Michael Jordan is to basketball, or Sachin Tendulkar is to cricket, he is that to ice hockey. He's a true legend and has won many titles. And when asked why he used to win, he always said, that's because I skate to where the puck is going, not where it's already been. And if you look at the right, there's a gentleman called Paul Graham, who's one of the guys who runs Y Combinator, which you all may be familiar with. And I'm just going to go to the middle of the box here on the right, where he says the reason that really good investors don't ask this, which is what? The median investor's first question is, who else is investing? And he says the reason really good investors don't ask this question is because they're more disciplined, or not because they're more disciplined, but because averaging their opinion of you with those of other investors would decrease their accuracy. And so these are two philosophies, right? And I think I tend to adopt both these philosophies. But if you look around, there will be funds which will ask you the question, right? Who else is investing? And you may want to also leverage that people are looking to find comfort in an expert, especially in areas that they don't have expertise in. And so very often, even if you look at angel network models, you may often have a champion investor or an influencer, in a sense, who has got a good knowledge or grasp of a space that you're in. Let's assume you're doing something in the biotech side of things. Very few investors truly understand biotech, or you have very complex product in telecom. Not everybody will know that, right? And if you have an influencer who's backing you, who understands that space well, especially at the early stages, it's always a great signal. So, this works both ways. There are investors as well who say, listen, I'm not going to figure out where the puck is going to be. I'm going to figure out that this is the area which has got momentum today. EdTech today is one of those examples. There's a ton of investment capital going there, and there'll be an investor saying, I don't mind backing the third company in a space that's doing well. And I mean, you had examples in the past, right? You had an Ola, you had an Uber, and then somebody invested in taxi for sure, and then eventually it was acquired. But not all investor will try to be the first investor. So try and understand this. What are the patterns that investors follow? Do they follow these philosophies, or they look at something else which is related to momentum investing and understanding areas where capital has already gone and proven itself? The other dynamic is that some investors look at models that have worked in China, for example, or in the US, and say, listen, this is perfect to be replicated in India today. What worked well in China maybe 15 years back or 20 years back, and therefore look at business models or offerings that replicate. And so that is the other pitch. Try and find out lookalikes for your business which have been successful in other parts of the world. You don't have to be a copycat, but being able to show something has worked somewhere else in some other context can sometimes help. We love it when people break the mold, to be honest. We love it when somebody is saying, listen, we're going to change the world and do something which has never been done before, as long as they're able to show their capability and the fact that they've gone a distance in being able to do that. But not all investors think in the same way. And, given that we're talking about the investment community, it's important to know that there's two sides to this coin. Now, the other challenge that we are facing all the time is we are plagued with something that I call information asymmetry. And essentially, information asymmetry is really when a buyer and a seller have very different amounts of information about a transaction. And so, as an investor, what are we doing? We are buying equity in a startup. And we, as the buyer, very often hear only the good things. We very often don't have the right data to make an investment decision. We don't have enough data. And a lot of our effort is actually going into trying to understand more and more about what is happening at the customer side. Uh, we hear about the successful pitches, the successful deals that are struck. Very often we don't hear about the ones that didn't go through. Some of that is hidden. So it becomes hard for us to assess this. And our challenge is constantly grappling with trying to get all the information that we want. So as a startup founder, when we see somebody come to us and give us a whole breadth of information which is really useful, the bad along with the good, then we realize that, listen, we've got all the information. Now we don't need to hunt for that. It's just now making or taking a decision quickly based on all that we have just makes the process a lot faster to start with. But we also appreciate the effort that the startup founder has put in trying to make our investment decision making an easier process. And so every time you think about the fact that we are facing this challenging situation, we need to also pitch to our investment committees and get approvals and so on. The extent of help that we can get from a founder is limitless in this journey. Explaining what they do, trying to give us a sense of how they go about it is invaluable, and we always appreciate it and have a preference to founders who can work with us to help us understand, to give us information, because we know once that the relationship is established, they will continue to do it as they go ahead, as they face challenges in the business. It will not be hidden from us, but they will come back to us and say, hey, these are the challenges we're facing. So always try and help the investor with the level of information that they need, because we're always low on that. So we all know about glass half full, glass half empty. And if I really were to try and interpret this picture from a startup entrepreneur point of view, or the dynamic point of view, very often, if you think of the middle glass here, that's how an entrepreneur, in my mind, often, sort of, or rather the one on the right, which is full, that's how the entrepreneur often views his business. And even at an early stage, when truly the business is what it is on the left, a small amount of water at the bottom, and you are really trying to say, okay, I'm at $1 million in revenue, or I'm at 1 crore in revenue, or I'm at 10 lakhs in revenue. The investor is thinking, hey, how is this going to go to the right bucket, which is the unicorn, or to a significant revenue number, whatever be the target. The entrepreneur is the one who's thinking opportunity very often, right? So he's already visualizing that distant day, or not so distant day, when it's reached that stage, and he's constantly projecting that stage. And so the entrepreneur always thinks about that full glass, and the investor sometimes moderates and says, here's the startup at the left side, but we do believe that it's half full. These are the risks. So the one in the middle is where we settle for, and we say these are the risks to really fill this glass up. These are the areas where this glass is going to break or develop or crack, or the water is going to evaporate. We try and predict risks. But eventually the mindset is different, which is investors think about risks and what could sort of derail a startup, what would not make it successful, whereas the entrepreneur is always thinking opportunity. And this is where the sort of dissonances in ideology very often come. And conversations will get a lot better between investors and startups that are pitching, the minute each party realizes and understands and absorbs, assimilates that this is how the other person is thinking and that's how their job demands them to think about it, right? And so this is something that requires to be appreciated as well when talking to investors. And then, of course, after all of this, after assessing all the risks, after getting whatever information we get, we do tons of diligence. At the end of the day, I can never imagine or think of a deal where I can say I've been 100% sure this is going to make it. Anybody who says that to you is, really perhaps, or let's say hats off to him. He's probably a Nostradamus. Every one of them will require a leap of faith at the end, and we say we believe these guys will do well because all these ingredients are good. But at the end of the day, we have to take that leap of faith. And that leap of faith, that distance between the two cliffs that you see this young girl jumping over, varies with every startup, or our perception of that varies. And we are far more willing to take that leap of faith when we have a lot of information, B, we've really been able to assess risks well, C, we think we can add value to the startup, and D, when we really find a good chemistry with the startup founder. And very often some of these are aspects that make that wide chasm or that wide leap look a lot smaller than it otherwise is. And so the interactions that are there with entrepreneurs bring some of this out. So if I were really go and away from the softer aspects to some of the nuts and bolts of our decision-making process, and this is perhaps very relevant to how we think about some of our investments, but could be applied to other funds as well. There are three broad categories we look at. The team, and you must have heard this many times, always we say team. I'll try and deep dive. Everybody looks at the market and the opportunity. And then obviously, what is the product, what is the technology, what is the service, and associated things that come under product, technology, and service. And somewhere between market and product, there's always at that intersection, product market fit, business models, all of that that get demonstrated or get evaluated. The second part, that what is it in these three things that we are looking for very often is what is really going to take this startup to volume, large volume. Scale is something that's at the top of our mind. Is this startup really going to scale? And there are some investors who will say, is this going to become a unicorn? There'll be earlier investors who say, okay, is this going to become, 10, is this going to deliver 10 times my return and therefore scale to 10x the valuation? Different expectations, but everybody wants is looking for scale. The second is not just the scale, but what is the velocity at which it will scale? If it's going to take 20, 25 years to scale, then you're outside somebody's investment horizon. Like I said, funds like us have a certain life span. There are angel investors who have their own sort of life cycle for their investment before they want to churn or get some returns. And different vehicles have different timelines and time frames. And so everybody is looking for scaling that happens at a certain velocity. And very often that is, 5-6 years is the longest. Some look at it even lower, which is 3-4 years. And so plans, projections, pitches have to be tailored to see how it will fit those time frames that will generate returns for your investors. Some examples, I'll be very brief about this. These are all startups that I've invested in, both from my last fund as well as this one. But on each of these, you can see all of these are startups that are doing extremely well. Mitra Biotech, Cerimac, Detect, and Entropic. And two of them we exited. Two of them are in my current portfolio, the second two. Very solid teams in some cases, in fact, in all of them, but certainly in one case, there was a second time founder, so they knew what they were doing. Versus in the case of Detect, there's, all of them were first time founders, but there were 5 of them versus 2 of them in, let's say, Mitra, just a solo founder, and Cerimac. So how does that vary, when we think about things? It's not that one is good or one is bad. When you have 5 founders, you can split work, but that also means that there's got to be the solid element of cohesion, which is there and needs to be demonstrated to us in our meetings and when we do diligence. when there's a single founder, there's a bigger risk. What happens if something happens to that founder, or if he's not able to motivate other people to join him going ahead as a co-founder, and so on. In fact, in Entropic, we now have 2 co-founders after the follow-on round of Series B funding. One of the existing senior employees was also made a founder, and so there are 2. So different models work. Each of them has its risks, and we try and none of them is right or wrong, but we will be looking at different things and different dynamics based on, let's say, what the team is like. We obviously look at market. Because we invest in innovative spaces, very often there's no $1 billion plus market that we are catering to. Very often it's a small one where there's market development that has to happen. So that's something we need to assess. And then if you look at the product piece, each of these were at very different stages. Early adoption, but it was a disruptive product. Early validation, not disruptive, but differentiated in the case of Detect. Again, in the case of Sedimac, differentiated, but already commercially adopted, and they were getting revenues. So very often it's 2 or 3 pointers that are looked at, and we may be more amenable when it is extremely disruptive or has the potential to disrupt when there is less market adoption. But at the same time, we're always looking to see what is it that is validated, what can we validate, how do we validate, and some of it can be revenues, some of it can be through POCs, and some of it can just be through some other data that is managed by the founders to be able to share with us, internal testing, certifications. There's just very different ways, but think about how you can show that what you're doing has got some validation already. What is it that demonstrates that this works at the stage at which you are? And each of these vectors on team, product, and market will move with stage. So if you're a seed company, founding team becomes extremely important. It's still in a situation where tech is still promise. I mean, there's a promise of good tech. It's still getting built out. There's a promise of disruption, and perhaps there's an existing market that you're addressing, right? And how does this move as you go along? The founding team in a pre-series A round should be established, should be a good founding team. By the time you go to a series A round, investors are looking at not just founding team, but more than that. Who else have you been able to inspire to join you at a senior level of leadership, maybe the next level of leadership starting? So that's why I put it as founding team plus plus. And as you go further right, it is not just the founders, but the full next level, whether it's a head of sales, different geography head of sales, some serious HR people, maybe a CFO, maybe a marketing head, and so on. And by the time you're hitting Series C, investors are really looking for a fairly fully built out team at the leadership level, and thinking about how capital can just scale it. Similarly with tech market, right? And if I take market in the seed stage, it's all a lot about there is a market or there could be a market. In a pre-series A, it is shifts, and you have an early validation from the market already. Some customer is already validating it. When you shift to a series A, people are saying, hey, you don't just have a market, you have customers with potential high ACVs or ARRs, which means that that this one customer, especially in B2B, is going to give you a $500,000 contract per year. Even if that takes 2-3 years, you've already entered that customer, and there's the demonstration of high ACVs or ARRs. In the consumer space, it will already be, repeat customers coming in. You will already have a large, wide adoption, a lot of conversion from, let's say, trial customers to paying customers, and so on. Series B market, yes, it is again a lot to do with how many customers are churning out. How many of them are really repeating? What is your LTV? What is the lifetime value of your customers? If it comes to the B2C space, and in the B2B space, other things like how big have you been able to mine an account that you might have entered into with a small ticket at your Series A stage. How big has that account become for you now? Have you been able to generate more revenue from that account? And going forward, it's to a Series C, you're already looking backward to see who's the threat, who else is emerging. Whereas in the earlier stages, you're typically looking forward and seeing who's there ahead of you. By Series C, you may have disrupted a market and looking to see who else will disrupt you. So some of these things change according to stage and based on when you want to raise money. Therefore, you need to project the right things in the right proportion. And founding team becomes very important at the early stages. Maybe some amount of tech build out, but there's going to be less validation from the market. So you would want to project some of the things which you've already established or which are important at that stage in a bigger way when you have a conversation with investors. So when you go through diligence, and I'll quickly go through how we do some of this diligence. Obviously, we diligence all these three aspects in many ways. These are just some indicative. There's a very small subset of all the things we look at. But there's the checklist of things that we look at. What are the founder backgrounds? What is their education? How many startups have they run before this? Is there one founder? Are there many founders? Is there a complementary skill sets? What are the personal backgrounds of founders? We do ref checks. What is the size of the team? So these are fairly standard, right, and fairly templatized. But this is where I look at aspects of the team which I feel are, let's say, the softer aspects of what we read between the lines that goes beyond that checklist. What is the chemistry between founders, right? How well do they get along? And there are cases where we found that is lacking and we have actually not gone ahead. We liked everything else about the opportunity and about the startup, but just because we weren't sure about the chemistry between the founders, we decided to pull out and not go ahead with the investment. Similarly, can you inspire and build in next level of leadership? If there are 3-4 founders, is there a clearly defined leader and a CEO? That is extremely important. So for startups there with multiple founders, try and figure out who's going to be the CEO and make a wise choice. Don't just choose the guy who's the smartest. Very often people with good people skills or founders good people skills are better CEOs than the smartest tech person, let's say, or the best salesperson, right? Somebody who's got appreciation of all the functions, founders, commitment. But ultimately, the big signal for us on team is how well has the founder understood the business dynamics and has clarity in their vision, understands all the moving parts of that particular space that they're sort of addressing, and understands, has a vision, but knows what are the obstacles and challenges to getting there, right? And very often one signal comes from when you have that conversation with an entrepreneur. You may have already looked at that space, evaluated that, but you can always tell when somebody's got a very deep knowledge about a sector and the dynamics through a conversation, and how much have we left that meeting learning so much more about that space is one of the indicators there. The second one on technology, again, these are easy. We look at a demo, what is the novelty, patents filed, what are the use cases built if there are multiple use cases possible. What are the outcomes? Have you demonstrated some of it, especially when it comes to a lot of the AI startups? What are accuracies? How much more time will it take to commercialize? What is the scalability of the tech? I mean, these are fairly templatized, and again, there's a longer list than this. And I think what we look at it, or the way we go about it, is really to see how much the tech is better than current state of the art or can become, how rapidly is it improving, and where is the current state of the art. So we look around to see what else is there. So very important for entrepreneurs also to project when you're raising capital, know what exactly is there out there, and not just in India but across the globe, and say these are the 3-4 things which are there. Make an apples for apples comparison. Don't compare yourself to, let's say, a legacy software. Compare yourself to that other mobile enabled software, right? So what is the latest stuff becomes more apple for apple than legacy. We often see founders doing an apple for orange comparison. But the minute you know that you've got these competitors and you can project why you're better than them or why you will be better than them, it's always a great start. Of course, validation of product is extremely important. Access to raw materials, whether it is a manufacturing type of play or even other type of play, access very often to different types of raw materials, whether it is good data science engineers in the case of an AI product, or whether it is a raw material in the case of a physical product, your access, you have to go to China for your supply chains and so on. All these are factors which are important. And importantly, how fungible is your technology, right? Can you take it and create newer use cases so that it can be scaled, or are you stuck with the limitation of what you're doing? And so these are some of the things which are again important for us when we read between the lines as far as tech. But ultimately, the big deal is what is the strength and sustainability of the tech moat. And because we invest in deep tech startups, we want to understand how solid is the technology you've built, how does it compare with existing technology, and how long will this sustain? Is it how long is it going to take for somebody else who starts building this to replicate it? And it's not all funds that look at the tech mode. It's us because of our deep tech focus. Other funds look at how technology enables, or many other funds look at how technology enables efficiency and then look at the scalability of the technology. But everybody looks at different modes, whether it's a business model mode, whether it's a tech mode, or it's just the team being the mode. What differentiates you, what sets you apart, what will give you the edge and help you succeed when others can't. And one of them could be technology for some funds. I think the third one is the market. And again, you all will probably know TAM, SAM, SOM. What are the segments? Who are the customer personas that you're addressing? What is the traction already? Who are the competitors? And what is the investor landscape is important. Are there later stage investors looking to back these type of startups, or is nobody investing in this space? And case an example, biotech in India, very few later stage investors. All our startups need to raise capital after Series B, C from outside India. So that sort of landscaping is very useful to understand and communicate. And we always have customer reference calls, so it's very important. Customers say a lot about you, which is positive. But the key for me, again, if I go away from checklist, what are the things we're looking at is, which in a solid manner, very often traction and pipeline is key. Who are the customers who are believing in you? What is the strength of your pipeline? And when I talk about that, this last point at the bottom, right, which is in blue, which says, as we are speaking to you, and if we have a conversation over 2-3 months with an entrepreneur, we are also seeing how many accounts is he adding, how is his pipeline progressing during the conversation. We're always seeking updates from the entrepreneur. I mean, we don't ask. The good entrepreneurs always send that our way and say, hey, these are the the customers we are onboarding. By the way, this new big company which is sitting, let's say, in New York, is talking to us, extremely interested, going to run a pilot. Those updates definitely make a big difference in our investment decision, especially as we are going through the cycle, right? We give a lot of importance to reference calls, so choose wisely as to who you would whose numbers you would give for us to make those calls. And ultimately it's about scale, right? And scale. We are always thinking, what is going to take you from 1 crore to $1 million, from $1 million to 10 million, 10 to whatever, 20 or 40, and to 100 million? Is what you have, is the market that you have, that you're addressing, going to be able sufficient for you to move across these stages or these levels of scale? And if not, would you have to pivot? Would you have to add use cases to increase scale? I think we try to assess all of that early. So try and think about it and have an informed view, because sometimes these could come up in discussions with investors as well. I think I'll stop here. I think there are quite a not too much time left. So happy to take questions and go through any sort of questions or points that I have not already raised in the last half an hour or 45 minutes.
So I have put in some questions in the chat box, so you can get from there.
Sure, Nitin. I'll take these. I've just opened that up.
Sure.
So what are the criteria and requirements for VC evaluation in a startup pitch? I think I just elaborated, pretty I mean, in whatever time I could, I gave as much detail as I could. But again, just to repeat, we look at these 3-4 things at a very high level: team, product, market, and then product market fit, business model, which is sort of in between market and product in our minds. And under each of these, there are so many criteria. I listed a few, but I'll tell you, these are extremely few. There are many, many more things we look at. This is just to give you a sense of some of the important ones and how we view them. So otherwise, it's an extremely long conversation. Try to touch upon some of that. What stage of startups did Bharat Fund invest in? So we have, like I said, 2 vehicles. Our impact vehicle invests at the seed stage. So product ready, some validation of the market. Our innovation fund, the Bharat Innovation Fund, invests at the pre-series A to the series A stage, occasionally in series B startups. And so we are looking for, again, strong market validation that takes place. And our check sizes out of the second fund are anything from 500K USD to 3 million USD first check, and then we follow up in follow-on rounds. The third question I see is, what are the ways to get funded for early stage startups? Yeah, I sort of skipped that in the beginning. I touched upon the fact that there are different ways, but I left that because that was not the focus of today's topic. But let me briefly address it. I think there are 3 or 4 or maybe 5 mechanisms that come to mind. The first one is grant funding. Very often, if you're in the healthcare space, there's a ton of great grants that BIRAC provides. If you're in the sustainability space, again, there are some grants which are available by foundations and what we call DFIs, Development Financial Institutions. So providing grant funding, you don't have to give away any equity for that. So it's almost free capital. And these are in areas which are come under development sector. So healthcare is very amenable, and so is sustainability or clean tech and so on. We have seen cases where a lot of founders, the ingenious ones, have actually won a lot of prize money. So through some awards, they have managed to fund their early development at a very, very seed stage. So that's one option. But after that, where do you go? You first step is friends and family, which is, if you have nothing, you getting funded for an idea is very hard. And so either you get funded for who you are, which means it's easier to go to people you know, which could be your boss at a company who says, listen, I don't care what you're going to do. I just know you so well that whatever you do, you will succeed. And then he may bring in some of his friends and say, hey, I know this guy, and so on and so forth. So that's the angel who falls under the friend and family / employer category. And then you have the external angels. There are a lot of them these days. Family offices are coming and investing in a big way today. You have angel networks which are there, quite a few going around these days. And if you graduate that, if either you raise money or you've gone past that, you can start pitching to early stage funds. There are accelerator programs which give funding as well these days. Some of those well-known ones are actually giving a fairly significant amount of funding. You might have all heard of the likes of Surge and so on. So early stage funds, and then you move to a VC fund, which is let's say Series A, Series B fund, and then private equity funding. I don't think debt is easy. Some startups raise debt along with equity. So going to banks, sometimes you get some CGT, type funding from banks. But if you're a revenue generating startup, then it becomes easier to get either debt or what is becoming extremely popular are venture debt raises these days. And normally you would get that in a Series A raise, or after that, if you managed VC funding, is when a venture debt firm will come and also provide you venture debt. What do? They give you debt at a certain interest rate, but they also take a minor equity stake in the company, or the option, or what is called a convertible, that they can convert a small portion into equity eventually if they think your startup is doing well. So these are the ways you can raise money at the early stage. I'll just move to question 4. Is it possible to bring angel investors, VCs, banks, governments to work on profit sharing basis with entrepreneurs on innovative technology products? Angel investors, I've never seen this happen. Maybe there are some deals which are outside of what I have seen, but mostly they want an equity stake, because then if they get a real upside, they can choose when to, uh, sort of when to exit, at what scale. And honestly, in the early stages, profitability is very low. Very often you're investing, it's a negative EBITDA business for the early stages. So for many, in the beginning, there's going to be hardly any profits. So very little visibility into that. So you don't see angel investors doing that often. You don't see VCs doing that often. Banks definitely not. I have seen some government programs, and I'm part of one committee where we do have a model for profit sharing. It's for a slightly later stage, sort of startups that are going into commercialization. And because we believe we're funding the commercialization part through this government program, we have arrived at a model where we do some amount of revenue share on that. So it's probably only the last one, but even government programs, there are fewer, simply because we don't know what is going to be the pathway to when profitability. And sometimes you may reach series C and your unit economics may be positive, but you're continuing to invest in the business so much that you're not profitable as a business. You will get to profitability, right? Your unit economics is very often positive, or your gross margins are in positive territory and good territory, but you may not be profitable because you're investing in building business and building teams. And so uh, tying our returns in an early startup to profits is not a model that works with us in general. I'll move to question 5, which is, what is your view on MSME digitization and how do you see it moving forward post-COVID? So let me broaden this question, and I will say what is my view on enterprise digitization, and especially this is all in the Indian context. Enterprise digitization has sort of scratched the surface in India, if you ask me honestly. A lot of the startups we invest in, and this may sound politically incorrect, we believe that the Indian enterprise market is still a limited market. We think the scale market, Indian enterprise market is a great test market. It's a great early adoption market, but eventually the scale markets, both in terms of velocity to closing a deal, as well as in terms of value of the deal, still come from outside India. But having said that, what is happening in India very clearly is digitization has begun. And every entrepreneur, every enterprise, every CIO is extremely keen on following a digital transformation journey. What is important is they've also become far more open to working with startups and using either open innovation programs or corporate venture capital sort of uh, models or accelerator models to bring in startups into their fold and help them in their digitization process. So you're seeing a lot of this activity. We work closely with a lot of large corporates to tell them, hey, these are the startups that could solve your problems. And very often we suggest startups that are outside our portfolios as well, simply because we want to build strong relationships both with the startup community and the corporate community. And so we arrange some of these pitch sessions and so on with corporates. There's clearly an intent. The problem has been so far that intent has not translated into sufficient action, sufficient decision making, and sufficient budgets. And very often, large enterprises get caught in this loop of should I build it internally versus buy? And they always think they can build something better than what is available in the market. What COVID has done is the level of acceleration it has provided to help a CIO build a business case and pass it through his masters in an organization, and to get some of this invest really, if you ask me, in digital transformation has got a big boost. And so I think this is going to change. Now, when it comes to MSMEs, I think the purchasing power of MSMEs is still low in India. And very often, while it is beneficial for them to move and digitize as much as possible quickly, they're often dealing with other priority situations. So I believe that while this is a must-have and a must-do, I don't think all MSMEs are doing it extremely well. And we are seeing, in fact, digitization of large enterprises of traditional sectors. So, for example, oil and gas, which is not digitized well, extremely large companies just starting to adopt digitization, and we have one company helping on that. Construction is another sector. We are seeing a lot of this going to play out. So it's still at a large company level. It will start filtering into MSMEs. Question number 6, does Bharat Fund invest in circular economy businesses? You can answer as per your wish. I think I've given a full description of what we are investing in a little bit more detail. So that's how I would like to answer this. I think in the first 2-3 introductory slides, I've managed to give a clear sense of what we do. But just to reiterate, in case somebody joined this conversation later and missed the first part, we invest out of 2 vehicles. One vehicle focuses on deep tech startups, which are globally competitive. So cutting edge technology startups across sectors, of course, early stage, and I've defined already what early stage or what we mean by that. And mostly B2B, though we have one B2C investment. So if there is a mix of deep tech and B2C, which is rarer, we don't mind. And we have looked at many and we've invested in one. The second vehicle invests in startups which are focused, which have a slightly more impact focus, which actually improves the quality of life of people in a lower economic section of society, which typically is your gig worker section or your cab driver, Uber driver section, your maids, maybe a lot more in tier 2 and tier 3 as well. And it could be in a variety of ways, which is better education focused at them, sometimes in vernacular languages. It could be financial products. It could be healthcare, which is specific to this section of the society, healthcare, even health insurance type products. So a variety of products that actually uplift the standard of living, or their ability to improve their standard of living or earning capacity as well. That is what we invest out of the second vehicle, which is the impact focused one. And we typically do seed investments out of that, anything from 200K US dollars up to $1 million as a first check. And then we follow on in the successful ones. So I think we're a little bit past our time. So Nitin, I think I'll stop. I think I've hit the last question as well. So over to you.
Yeah, I thank you, Mr. Raghuraman, for sharing the details on how startups can get investments and how they should reach investors for funding. So we would like to end this session here, and if any of the participants have any questions, they can write in to us at startups@ficci.com, and we can then share it with Mr. Raghuram and can get the queries answered. So thank you from our side, sir.
Thank you. Pleasure being here. Thank you so much, Nitin.
Thank you for your time, sir.
Everybody was here.